Welcome to The Explainer. Let's jump right in because today we're unpacking a topic that is absolutely critical in the modern consumer finance landscape: data privacy. Now, we all know customer data is essentially the currency of the digital age, right? But misusing it, that is a literal regulatory and financial minefield. In this explainer, we're completely decoding the strict SASB, which is now ISSB, disclosure requirements for the consumer finance sector. Specifically, we're looking at exactly how you must report the number of accounts used for secondary purposes and the total monetary losses stemming from privacy-related lawsuits. Bottom line, if you deal with consumer data, you need to know how to measure and report these metrics.
And the framework itself makes the stakes incredibly clear. Failing to manage these privacy risks isn't just about getting a slap on the wrist from regulators. It directly erodes consumer trust, which, as you might guess, leads to higher employee turnover and ultimately severe financial consequences. It is, quite simply, a bottom-line issue.
Okay, let's dive into this. Here is our roadmap. We'll start with the privacy imperative, tackle metric 1 on secondary data, define data and consent, and then wrap the whole thing up with metric 2 on monetary losses.
Part 1. The Customer Privacy Imperative. Our focus today zeroes in on two really strict quantitative metrics. Code 220A.1 requires you to report the exact number of account holders whose information is used for secondary purposes. And then Code 220A.2 demands that you quantify the total amount of monetary losses resulting from legal proceedings tied to customer privacy. So no fluff here, just hard numbers. Just for a little context, these SASB standards are now governed by the ISSB, the International Sustainability Standards Board, meaning these metrics aren't just some niche accounting quirk, they are a globally recognized benchmark, absolutely crucial for transparently reporting sustainability-related risks to your investors. Moving right along to Part 2, Metric 1, Secondary Data. First off, we really need to clarify exactly what a secondary purpose actually means. The standard defines it as intentionally using data outside the primary purpose for which it was initially collected. Now, we aren't talking about accidental data leaks here. This is about deliberate business practices, things like selling targeted advertisements or transferring data to a third party through a sale, a rental, or sharing agreement. And here is a highly critical detail you can't miss. Even if you're just providing this information to your own controlled affiliates for them to use for a secondary purpose, that still counts. And yep, it must be reported.
Now, what's really interesting about this slide is that the framework doesn't just want a generic data headcount. It demands that you track 4 highly specific categories of account holder information: demographic, behavioral, location, and personal data. Let's quickly define each of these so you know exactly what falls into which bucket.
First up, demographic data. This is the information that identifies and distinguishes a given population. So if you're filtering your users by age, gender, race, or even something like whether they own a home to target them later on, you are pulling directly from this bucket. Next is behavioral data. And wow, this one is absolutely massive in the digital finance space. It tracks, measures, and records individual behaviors. If you're logging a user's online browsing patterns on your app, their specific buying habits, or their brand preferences, and then leveraging that to sell targeted ads, that action directly triggers this reporting requirement.
Then we have location data. Conceptually, it's pretty straightforward, but it's incredibly sensitive stuff. It describes the physical location or movement patterns of an individual. Think along the lines of logging exact GPS coordinates every single time a customer opens your mobile banking app.
Finally, personal data. This kind of acts as a catch-all for any information relating to an identified or identifiable living individual. And you really have to keep in mind the mosaic effect of data here. Even if single data points don't identify someone on their own, if various pieces of collected information can be aggregated to lead to the identification of a particular person, that entirely constitutes personal data under the standard.
All right, Part 3, Defining Data and Consent.
This seamlessly transitions us into the qualitative side of the metric. You've got to report your policies regarding customer consent. The standard zeroes right in on the concept of an opt-in policy, which is defined as requiring explicit, affirmative consent to use or share content. Basically, you can't just hide a pre-check box at the very bottom of a 50-page terms of service agreement anymore. You have to clearly describe your procedures for disclosing secondary data use to your customers.
So, the crucial point is that transparently reporting your consent process involves two very distinct steps. Step 1. You must detail the nature of the consent. Is it truly explicit, freely given, specific, and informed? Step 2. You have to detail the extent of your disclosure to the customer. Do they know precisely what specific data you intend to use? Do they know exactly which third parties have access to it, and exactly how those parties will use it? If your reporting doesn't answer these questions, it's simply incomplete.
Let's pivot to part 4, Metric 2, monetary losses.
And this brilliantly illustrates how strict the accounting rules are about what actually counts here. When reporting monetary losses from privacy-related legal proceedings, you absolutely must include direct liabilities. We're talking your settlements, regulatory fines, penalties, and restitution. However, the standard dictates you must entirely exclude your legal and other defense fees. In other words, the framework measures the penalty of the failure, not the cost of fighting it in court.
Furthermore, you really have to understand the wide net cast by the standard regarding where these proceedings originate. The scope includes civil actions, regulatory proceedings, and even criminal actions. Whether the adjudicative proceeding involves a court, a regulator, or an arbitrator, if it resulted in a monetary loss tied to a customer privacy incident, it goes into this metric, no exceptions. But look, simply dropping a dollar amount on a spreadsheet isn't nearly enough. Entities must contextualize the loss. Step 1. You must describe the nature of the loss. Was it fraud, or maybe a failure to properly disclose data use to clients? Step 2. You must describe the corrective actions implemented in response. You have to prove to your investors that you are actually fixing the underlying issue, whether that means overhauling your operations, upgrading your tech, or implementing entirely new management training.
Ultimately, as we review all these complex requirements together, it's pretty obvious what the ideal target is: zero. Zero unauthorized secondary data usage, and zero monetary losses from privacy lawsuits. This standard exposes risk. By forcing companies to meticulously track these metrics, the framework pushes the entire consumer finance industry toward better, more secure, and infinitely more transparent practices. So, as we wrap up this explainer, I want to leave you with a question to seriously consider for your own organization. Is your customer privacy reporting clear enough to protect your long-term value and retain investor trust? Because as we've seen today, technical compliance isn't just about ticking boxes anymore. It is directly tied to your sustainable, long-term business success. Thanks so much for joining me on this deep dive into the data, and I'll see you in the next explainer.